All right. Good afternoon, everyone. Real pleasure to be here. Just a quick intro. This won't be a sales pitch, but Callan is an institutional investment consulting firm. So we work with pension plans, both public, corporate, and other institutional investors. We have a big cohort of public pension clients. We work with about 60 public pension plans around the country. So I think we provide an interesting perspective. In this paper, we tried to attack three questions mainly, which was the first was the evolution of public pension investing. How has it evolved? What were the forces behind that? Secondly, what defines a current portfolio for public pension plans? And then thirdly, what's the next phase? What are some going to be the big influences that affect public pension plans? The transformation that we're going to talk about was really structural more than anything else, and it's really...
Callahan.
What's that?
Oh, we just need to meet the Zoom. We have to do it.
Sorry. So the changes were structural, and it's really redefined how public pensions define and implement risk. Okay? The core thesis of this paper is that investment risk has really become governance risk. And I'll explain what that means as I go through here. So public DBs today look very different than they did 60 years ago. So we went back to the early 60s to begin the analysis that we did. If you go back to the 60s, and I'll get into this in another slide, but investments in public DBs were predominantly fixed income. And today they look very different. They're diversified portfolios. They're largely growth-oriented. Fixed income is a much smaller allocation. And most employ heavy allocations to alternative investments. And I'll define what alternative investments are and how that's shaping the landscape currently. This change was really due to necessity. I'll describe why. And a whole confluence of factors, and those are what's listed on this page here. It starts with the secular decline of interest rates. So this reduced the return of fixed income and the forward-looking expectations for fixed income returns. At the same time, it increased liabilities as liabilities were being discounted at lower interest rates. Demographics were a big influence. You have aging populations. You had increased longevity for beneficiaries. And you had a change in the ratio between active employees and retirees. I'll get into that. At the same time, you had significant policy changes on the public spectrum. Funding reforms and accounting standards were introduced. It resulted in more discipline and visibility as to what liabilities looked like, and it put a lot of pressure on contributions for public pensions. And then we had markets. We had some pretty ugly periods. We had the dot-com bubble. We had the GFC. We had the COVID decline. That put pressure on funded status for public defined benefit plans. And it put more pressure on returns to try to get out of the drawdowns that we saw. So what has been the evolution of asset allocation for public pensions? So as I mentioned, we started in 1962, and you can see that these were predominantly fixed income. There were largely at the state levels statutory and governance constraints that really prohibited pensions from doing much more than that. And importantly, most were pay-as-you-go. Right? So that's kind of how they were funded at those times. And then you can see we kind of skipped pretty far into the 80s here, but there's a couple of things that changed. The first is that pensions started using actuarially funded methodologies to fund their pension plans. Fiduciary standards started to become much more onerous. So public pensions aren't subject to ERISA. ERISA was passed in 1973. But at the state level, most public pensions started to adopt ERISA-like fiduciary standards of prudence. And then you had the embrace of modern portfolio theory that's going on with all of this, which is building efficient portfolios, diversified portfolios. So you can see by 1985, you had portfolios that were some combination of public equities and fixed income. And then you fast forward into the 2000s, right? Now you have very diversified portfolios. Public equity, which back in the 80s was pretty much exclusively U.S. dominated, We're now globally oriented, so not investments in the U.S., non-U.S., and emerging markets. And then you've got this other piece over there. And that's the big change, and that's the one that's had the biggest impact is the other, in this case, is the growth and explosion in alternative investments. And again, I'll get into that in some detail. This is the big driver, was the decline, the secular decline in interest rates, right? So you go back to 1980, the 10-year yielded 15%. On March 9th of 2020, when COVID just kind of became the big thing, the 10-year went down to, I think, 0.52% on March 9th. So that's a pretty incredible decline. And this took a long period of time, right? And the implication, as I mentioned before, is fixed income returns decline as a result of this, and liabilities increase. And so fixed income as an asset class just became insufficient to meet return objectives. At the same time, you had public pension plans actively trying to move down their discount rates, but fixed income really still didn't solve the problem. And it was a multi-decade decline, as you can see. And this set the stage for that asset allocation evolution. So the introduction of public equities and the introduction of alternatives helped solve the return problem to some degree, but it created a whole bunch of other problems at the same time. It increased fees, it reduced liquidity, it increased complexity pretty significantly. So it was a rational response to the decline in interest rates, but it was one of trade-offs. At the same time as that, we had a pretty significant change in liabilities, right? Plans were maturing, as I mentioned before, so you had an increase in longevity for retirees. The ratio of actives to retirees went down significantly. You can see in the 70s and 80s, on average, it was 4 to 5 actives per retiree, and today it's about 1 to 1.5%, or 1 to 1.5 times actives to that. So that's significant, right? And then mature plans have gone mostly into negative cash flow mode. And what that means is that the benefits that they're paying out on a monthly, quarterly, and yearly basis exceed the contributions that they're taking in every year. Okay, so that puts a lot of stress on liquidity for an investment program. In parallel, you had funding becoming much more disciplined, shorter amortization periods for unfunded liabilities. You had closed and layered benefit structures that were being created. And again, this put a lot of pressure on contributions and increased the requirements for contributions. Liabilities became much more visible. GASB 67 and 68 brought liabilities onto balance sheets, so much more visible for all stakeholders, and in some cases very shocking. And so the system really emerged from one back in the 60s that was very flexible, again, pay as you go, not a lot of rules, to one that had much more accountability. So I mentioned the pressure on returns, the decline in interest rates, and the growth in alternative investments. So alternative investments, what are they? It's kind of a big bucket. I think the way it initially was manifested in public DB plans, I think the first thing probably you saw of any substance was real estate, commercial real estate, then private equity, hedge funds to the next degree. And now we're in an environment today where it's all of those plus private credit has become a big asset class for interest. Infrastructure is another one, and other areas as well. So alternatives are not only growing, but the definition of what's in alternatives is growing. We joke internally, we say, if everyone has them, are they really alternative anymore? So we call them private assets and other real assets, maybe it's the other thing. So you can, again, a lot of advantages to alternative investments or private assets, higher expected returns, this potential capture of an illiquidity premium. They're a diversifier. And in the case of real assets, they provide some sort of inflation hedge. and that their cash flows may be tied to inflation, maybe not, the most perfect mechanism for that, but certainly have some inflation-sensitive features to them. But at the same time, these are generally illiquid assets. They come with much higher fees. The valuations are typically lagged, which is a really big deal. And if we get into questions about this rage about moving alternatives into defined contribution plans, that's going to be a big one. And it requires a lot more oversight. These are much more complex, right? And so that's where this idea of investment risk is really becoming more governance risk the more this becomes part of a portfolio, right? So that was a big one. What is the current portfolio for the average public pension plan look like? This is kind of a rough outline as to what the averages look like. Public equity represents the largest exposure in these plans. Fixed income, you can see, again, once all of plan assets, now down to levels in the 20 to 30% range. I would argue that when fixed income is at those small of an allocation, it doesn't really do much except provide liquidity for a plan. It's not really providing any significant diversification benefit. The risk of the total portfolio is driven almost exclusively by public equity and alternative assets when it's there. So fixed income really becomes the liquidity source. I talked about private equity and private credit becoming return engines, becoming diversifiers, and then real assets becoming not only return and diversifiers, but also providing some inflation hedges. So there's a lot more sophistication that's needed to manage a portfolio like this, especially compared to a fixed income exclusive portfolio, right? Risk management becomes center, right? And importantly, asset class labels don't really do the trick anymore, right? Just because you see certain things that have labels but may behave very differently. So investors are really forced to think about their portfolio in other terms, looking at things like factors, scenario analysis, drawdown. How are different assets going to react to different regimes and environments and factors in portfolio? So it becomes a much more complex risk management operation. And I think, again, this is important because the primary risks that are now identified are funded status drawdowns, liquidity shortfalls, and prolonged recoveries after market dislocations. If you're a negative cash flow plan and you have a drawdown, it takes you that much longer to get back to where you're going, right? Especially if you're part of what your path to get back is going out in benefits every year. Okay, so that's a big one. So where are we today? We're kind of entering this period where I think the general consensus is that there's heightened macroeconomic uncertainty. We may be in an environment with higher rates, higher inflation for longer, higher dispersion of outcomes, right? Less reliability on the diversification benefits that maybe we saw in the past. 2022, great example of this, right? Equities down 18%. Oh, my bonds are going to help me out. Well, no, they were down 13%. So the diversification benefits, I think, that were relied on, the correlations that people expected, those are now very different, right? So a couple of things that we've identified here that I think are going to be front and center for investors going forward. Private markets are still going to remain core to portfolios. We don't think that's going to change. There is going to be much more focus and need to spend time on capacity. Implementation risk is always been important in the private markets, but I would argue is going to become that much more, especially as they grow and as other investors start to participate in the private markets. Liquidity management, liquidity planning around alternatives is going to be key. So they're here to stay, but there's going to be a lot of new tools that are going to be needed to manage them effectively. ESG, it's kind of a third rail discussion in most conversations. Very politically charged, very controversial. You could be in one state and that's all they want to talk about. You can go to another state the next day and if you bring the topic up, they kick you out of the room. So very controversial topic. I would argue that a good fiduciary who can argue that there's material financial risk in ESG factors will win the argument at the end of the day. And it will have a place and a role in portfolios. It's not a political thing. It has material impact on the risk of portfolios. I think that that's clear, and it's easily argued and will trumpet the political discussions. And then the final thing we identify here is technological innovation, right? AI, I know someone said they hate that term before, but it's here. Data, blockchain, these are all things that are going to dramatically affect how portfolios are managed by asset managers and by asset owners. You're already seeing massive efficiencies through technology in the middle and the back office. I think it's moving into the decision-making process. Where that's going to go, I wish I had the crystal ball to tell you. All I know is it's coming fast. And if we were to come back here next year, there'd be a whole different story around it. So, the final point that we make in this paper is, what defines, in our view, what defines future success for a public pension plan? And we think we've outlined a number of things in the paper we think are key objectives for strong systems going forward. The first is to establish a really strong link between the three main key policies that govern public pensions. You've got a benefits policy, what do I owe? You've got a funding policy, how do I pay for it? And then you've got an investment policy. And they all have to talk to one another. Right? Your investment policy has to be set explicitly to how it's going to be funded and what you owe. And the others need to be cognizant of the other two policies as well. So having a very strong link between those three policies is going to be key. The second is a formalized liquidity management program. And that's not something that you set and forget. Just because whatever you model today on what you think liquidity is going to be, it's probably going to be different tomorrow. And so if you're thinking, I'm going to get a certain amount of exits from my private equity, and I'm going to have new commitments next year, and I'll just match the two, you're probably going to be sadly disappointed. Right? So that's something that's going to have to be stress tested frequently. The assumptions are going to have to be updated routinely to make sure that your liquidity is able to meet your obligations. The third thing is improving transparency. And this, again, as private markets grow, they're notably opaque. The fees are really high. They're complicated to calculate. The valuations are lagged. Again, there's a lot of problems around this. And stakeholders don't understand them. And so they get critiqued often, especially when there's periods of stress. And so there's this constant need to be transparent about fees. Why do you have them in your portfolio? There's an education process for trustees and other stakeholders so that you can have the discipline to hold on over long periods of time. The fourth concept here, which is a really important one as I see it, is investing in what we're calling governance capacity. Investment risk is now governance risk. And so organizations that are going to run these complex portfolios need to have appropriate staff and expertise to manage those portfolios. Boards are going to have to really think about their responsibilities and what they allow staff to do versus what they take on themselves. That's going to be really important for the successful management of these programs. And there's ultimately it ends up with this focus on the resilience of these investment programs through different economic regimes and other things. And so the takeaways, again, there's been a pretty dramatic change in how public DBs are invested. The decline in interest rates really being the big driver, although there's demographic influences as well, and we've seen market drawdowns. Diversification into alternatives was definitely a very rational response to that, but there's a trade-off of higher fees, illiquidity, complexity. And so the next phase is really going to be this idea of managing all of that complexity with discipline, transparency, and resilience. My time's up. Thanks.